Thank you guys for all joining us this morning. Pretty excited to be able to present this. Really excited to have Amanda Burling from Baker Tilly Staples Rodway presenting for us today. Having a look through the list of slides that we've got, and I think that there's some real core stuff for us all. Jordan Hartley Smith is going to be assisting Amanda where appropriate.
I'm Amanda Burling, and I specialise in accounting, software systems, management reporting and forecasting predominantly for the agricultural industry. That's where my passion lies. And I'm based in Taranaki. I actually live in Stratford, so I'm feeling the fresh mornings but beautiful days at the moment as well. I grew up on a dairy farm in South Taranaki out at Ararata, and then I've worked in the industry ever since, so that was including going rousing when I left school, and then I've been in the accounting field for the last 18 years, so got a bit of that background to support me with this. I really love educating. I'm really passionate about keeping our rural communities strong, and my way of contributing to this is to try and share my knowledge by empowering you guys, and with the goal that improving your financial knowledge or just understanding is hopefully going to enable you to make better business decisions. Sorry if I'm stumbling on my words. So welcome everybody today, and hopefully you get something out of it. If you're finding that I'm speaking too fast or I'm too quiet or anything, just let me know and I will see what I can do to help fix that up. So yeah, so can we jump to the next slide, Mark? And jump one more. So why I decided to do this presentation. So this is the first time I've run it online, but I have run it in person before. I was hearing a lot of things when I was attending farmers forums and other workshops within the sheep and beef and dairy industries, that they're struggling with lots of things. So things that I was hearing was all the good ones are exiting the industry. It's really hard to get and retain good staff. We didn't understand the consequences, actually. We wouldn't have done that if we'd understood. They could only focus on 1 year at a time, and they wanted to plan for the future, but we didn't know where to start. So we thought as a firm that we could support these people. And we thought, well, let's start with creating some new norms. Let's do some goal setting, budgeting, planning for the year and years ahead. So, and we think that should be as much of part of your business as carving or AI is. Understanding what your numbers are telling you is going to enable you to be proactive and make good decisions when they're needed. And in time, this is going to allow you to offer support and advice to others. And through your farming practices, you'll become role models for the industry, and even mentor some people coming through if that's your jam. By understanding these impacts that you can have on your own business, we're going to hopefully create quality employers. And one of my favourite sayings, of course, is work smarter, not harder. That was my dad. My dad always thought that if he could make it so that mum could do it, it was easier for him. And that's sort of a lesson that stuck with me, really. So when I first started researching this course, I came across a really cool article that Dairy NZ had made. So can we go to the next slide, Mark? Okay, so I came across this article called 10 Attributes of a Top Dairy Farmer. And Phoebe has sent out this article as a link after you registered to this. So hopefully you've all had a chance to have a look at it. So while this article is reasonably old, it was written in 2016, many of the points are still very accurate, very relevant for today. So within these things, you can see that points 4, 5, 7, 8, and 9, they relate to how you farm and the advice that you get around that system. And while I'm not in a position to help you with those things, I can help you with the other ones. The other important thing to note is that all of those things will have an impact on your financial plan. So point number 1, long-term goals are essential. A clear vision for the future is present, and this is what was found by the people doing the article. A clear vision for the future is present and understanding of why they are farming. Short and long-term goals are regularly reviewed. Good, positive people surround the business, information is shared, and a good team of professionals like bankers and accountants are used to discuss farm performance and longer term strategies. So we can help with all of those things. The second one, farm systems are profitable, replicable, and simple. Key farm management decisions revolve around profit. The farm system doesn't change significantly as milk price changes. Being profitable, no matter the milk price, is important. This applies to all farms from systems 1 through to 5. The farm systems are simple, easy to operate and describe. This also made it easier for many of the farmers to eliminate marginal expense items that did not have enough returns. We can help with this as well. Point number 3, they're very strong on financial management. Aggressive debt repayment is practiced during high payout seasons to reduce risk. The farmers generally prepare budgets and have full ownership of them. Monthly cash flow budgets are monitored extremely closely. Adjustments are made to budgets as milk price changes, i.e. repairs and maintenance or fertiliser expenditure. Detailed benchmarking is undertaken. These farmers know how they perform from season to season and against their peers. We can help with this as well. And then number 10, expenses are kept to a minimum. We can help analyse these results and look for improvements going forward. So you can see how, despite the fact that that is an old article now, it's 4 years old, everything is still really, really relevant, and it really highlights how that financial management plays into the increase in production. We'll jump to the next one, Mark. Okay, so that article pretty much summarises everything that I want to cover. We can't get through all of that today. So today we're just going to cover how to read a set of financial statements, how profit translates to equity and what that equity actually is, different methods for valuing livestock, the theory behind some income equalisation deposits, and the depreciation regime and things to think about when you're making capital asset decisions. Okay, next slide, Mark. So some of the tools that we use to help us help you really. We work with a variety of software solutions. We do not believe, as a firm, we do not believe that there is a one size that fits all type of accounting software. We will always sit down and do a needs analysis of your business and then offer some solutions. Using software can make keeping on top of your finances more achievable and can put you in charge of the outcome. Control the controllable is a key focus for me as well. Next slide, Mark. So one of the tools that we're using is HubDoc, and HubDoc is basically a cloud-based filing cabinet with some smarts. It will do some automatic data extraction, making the process of storing your documents simple, and it can be used as part of an accrual accounting system, or it can just be used as a filing cabinet. Either way, it makes it easier to get your books to the accountant for year-end work, and it enables easier support options throughout the year. What I mean by that is that we can access it. So all you need to do basically is upload your documents into there, and then we can see it. So if you've got any queries, we can talk to those queries much simpler. Next slide, Mark. So another key thing that we use is Dira and Figured. So Dira is the financial management software, and Figured is the farming management tools, really. Financial farming management tools. We can convert from other systems to use this product. It's up-to-date, real-time information. We keep track of livestock with an up-to-date livestock reconciliation. We can update any payout predictions at a click. It's easy to file GST, create budgets, short and long term, reviewing cash flow, analysing variances, generating KPIs, and it's cloud-based and accessible anywhere, so you can still have a look at this while you're on holiday, if you get a holiday. Another one is MYOB, so this is an easy conversion from Banklink if that's what you are currently using. MYOB Essentials includes payroll for one employee, but it does have some limitations for agri. It's got basic budget functioning, online GST filing, it's cloud-based, accessible anywhere. It has a document in tray, which is similar to HubDoc. PaySource, this is a payroll system. It's easy to enter time via an app that your employees would have on a phone, or you can do it manually if that doesn't suit. Leave requests are submitted via the app. Payday filings taken care of. Payments made to employees. PaySource can do that for you, so you don't have to do that part. PAYE is paid to the IRD on the due date. Again, they do that part for you. It's straightforward setup, and it calculates the top-ups required to avoid any of those minimum wage issues. And again, cloud-based, so it can process from anywhere. We've had people who have forgotten to do the pay run and they've gone away to a funeral or something, and then they've still been able to do it. So that's really cool. So that was just a quick overview of some of the tools that we use to help us with your business management. So let's get into understanding financials. So each part of the financial statements fit together like a puzzle to make a whole, as illustrated here, and each section tells a different part of the story. So I've illustrated here the livestock trading account balance sheet, or the statement of financial position, and the statement of profit or loss or financial performance, and the tax summary all tie in together to give us the information that we get from our financial statements. Next slide. The financial statements tell us the stories, different stories from each section. So one of them is what prediction we have done. Sorry, I've just got a phone call coming in that I'm going to silence. There we go. What production we have done, what stock did I start the year with, what have I bought and sold, and what do I have left, and what accounting profit have I made, and what is our net worth, which is our equity. Oops. Okay, so our balance sheet, it's a set of scales, okay? So I really like this illustration as it shows us that the assets, liabilities, and equity are all part of this balance, and you can picture what could happen if the liabilities increase and the equity decreases, etc. So it shows you the equation, which is assets equals liabilities plus equity, or as this is shown, assets minus liabilities equals equity, okay? So next slide, please, Mark. So also with the email that you received from Phoebe, there was a set of financial statements. So if you've got the ability, if you've managed to print them off, or you've got the ability to look at them while I'm talking, feel free to have a look. And this is referring to page 10 in our handout. Okay. So this is what we call the balance sheet, and this is a statement that shows what a business owns, what a business owes, and the portion of the owner's interest, which is the equity. And I just have forgotten to open my version of that, so I'll just pull that open. So if there's any questions, now would be a great time to go over some, Jordan.
I think it's come through just yet, Amanda, but just for everybody who has joined us more recently, thanks for coming in. So just to note that this has been recorded, so you'll have the access to the very beginning of it as well. Just on the bottom of your screen, and you may need to hover your mouse down there to see it, you'll have a little chat function there. So if you click on that, you'll have the ability to add any questions in, ask any questions as we go along. You can type them in there and we will jump back in and get back to you either live or at the end.
Awesome, thanks, Jordan. Okay, so you can see on page 10 that things that are classified as assets are your cash on hand, your debtors, which is the people that owe you money, your livestock that you own, any plant and machinery that you own, investments that you own, like Fonterra shares, land and buildings, and also any loans to shareholders if you're in a company structure. Under the liabilities, you can see overdraft facilities if that was necessary, creditors, which is people who you owe money to, any of your tax payable, any family debt or any bank debt, okay? And as well as that, if you're a shareholder and you own the company money, then that would be showing as a liability in that area as well. And you can see by looking at page 10 that your assets basically less your liabilities equals your equity, which is what we saw on the scales slide. Okay. So what is the balance sheet actually telling you? Can you jump slides, Mark, please? So assets are things that you own. So that's any cash, equipment, machinery, vehicles, etc. Liabilities again, we saw it on the previous slides, but some examples of those are your overdraft balance creditors, which is accounts payable or people you owe money to, tax and GST, family debt, bank debt, loans from shareholders or investors, okay? The owner's interest, which is your equity, and that's made up of a number of different components depending on your structure. For a company, this will be share capital and any reserves, but the major part is the retained earnings. So the strength of your business is going to be directly linked to the income that you bring in and the profit that you generate through the business. But also, it is also impacted with the equity that you start with and any debt that you hold. So that debt level is quite important as well. So where does equity come from? Equity is the cash that is invested by the owners, plus any income that's earned by the business, less any losses that are made by the business, less any funds that are distributed to the owners. So the effect on equity, this is a really basic demonstration of how this is going to work. You can see in the first section, in the opening position, that this business has $1 million worth of assets, $800,000 worth of liabilities, which is leaving $200,000 of equity in the business. They had an average year, and the accounting profit was $80,000. Under example 1, you can work through, and you can see the effect on equity when we take more for drawings than if the business has earned. So you can see the opening equity of 200,000 plus the 880,000, sorry, of profit, less the 90,000 they've taken for drawings equals 190,000. So that's a reduction in equity. And they still have tax to pay out of that. They don't have any more. So of course the offset of this is that they've increased the liabilities, and this is based on an assumption that they've borrowed that additional $10,000 that they took from the business, okay? Under the other example, example 2, you can see that they earned the 80,000, but they only withdrew 60,000. So that's left that additional 20,000 in there. So the equity has increased to 220,000. And this has been offset in a reduction of debt. So you can see the liabilities have reduced. Cool. Let's jump to the profit and loss. So this,
just a quick question here, Amanda.
Cool.
Got one through from Kathy, which is a really good one. So it just says, when you're talking within the industry and talking about farm working expenses, just wanted to know, does this equal the total expenses from your accounts, or is it minus the standing charges? And so, Kathy, probably when we're talking about farm working expenses, usually you would exclude the standing charges. And when we talk about standing charges, we're talking about, interest, lease rates and the like. And that's because, it probably makes a more comparable number, if you like, that, just because one farm has a lot more debt than another, it doesn't necessarily mean it's operating more efficiently in terms of farm operations. So the farm working expenses is intended to cover, all of those on-farm costs, repairs and maintenance, vehicles, that type of thing, but it doesn't include that interest. And for that exact attention, that then if you're looking at it in terms of dollars per kg of milk solids, it becomes a bit more of a comparable figure between farms.
Cool. And we'll go over that a little bit more once we get to the, go through the profit and loss too, I think. So, cool. Okay, so the profit and loss, we're now looking at pages 11, 12 and 13 in the handout, if you've got access to that. This report is also known as the Statement of Financial Performance, and it groups all of your income and all of your taxable expenses, and it's usually produced to calculate your taxable income for the year. The intention of this report means that it's prepared for you at your balance date, which means it's already happened. It's a review look. However, utilising some of the functionality in the software systems that I talked about earlier, we can actually gain a snapshot of this throughout the year, so that does help us with tax predictions and things going forward. So if we look at the next slide, we go into what it's actually telling us. So what is the profit and loss telling you? This is showing you all of the sources of your income and all of the expenditure that relates to your business for a given period. This period is usually 12 months, but there are variations to that if you're going through a restructure or you're just started or something. It includes all of your debtors and creditors. So that means that we've prepared it on an accrual basis, okay? So it's going to vary from your cash flow, which is only looking at money that's come in and money that's gone out of your business. Again, this report is historically a historical report, so it shows what's already happened rather than predicting a future position. But it is a really useful tool, and it's really good to review your performance and it gives a good reference point for budgeting and for future periods. Yeah, The cash profit is the difference between cash received and cash spent, and that's reflected by what's in your bank account. So not necessarily what's in this report, and that's how it varies, but that's what forms the basis of your cash flow. The accrued profit, as mentioned earlier, that includes all of your income and all of the expenses that actually relate to this period. So the key one there is say you've got a May balance date, the milk production that you earn in May but you don't receive until June, that is brought into these financial statements. And transversely, expenses that you incur in May but don't pay until June, they are also brought in. So that's all involved. The P&L also includes the non-cash transactions, such as any movement in livestock values and any depreciation. So they're non-cash expenses that do impact your profit. And again, what we're looking at when we do this report, this statement, is your accrued profit, so not cash. The depreciation. This is a topical by itself. So depreciation is how we deal with assets, basically. So an asset is anything that contributes to your business and cost over $500, exclusive of GST. Now, from the 16th of March 2020, as a response to COVID and in an attempt to stimulate the economy, this amount's actually been lifted to $5,000 for this year. From the 22 financial year, this amount has been proposed to drop back to $1,000. So that's still an increase. We can now expense anything under $1,000 from going from 2022. The depreciation regime allows for this expense deduction to apportion the cost of an asset over a period of time. So that's reflecting that an asset has value to you for more than 1 year. So the regime that the IRD announced is that we just claim a portion of that each year. The rates that we apportion it at are announced by Inland Revenue, and there are different methods that can be elected. So these are mostly, the ones that we use most are diminishing value and straight line. Diminishing value is a calculation which is the percentage of a declining book value. So I'll go through an example shortly. And the straight line it assumes that there's a useful life of a product. And so it might say, well, that product's worth 10, it's going to last for 10 years. And so 10% depreciation each year, and that the total adds up to the full value of the asset. If we go to the next slide, I can give you a demonstration of those. So the first one is an example of a diminishing value. So we've purchased a Toyota Hilux for $60,000. We purchased it on the first day of your balance date, so we've got a full year in each of these years, just to keep things simple. So you can see for the first year, we've got opening book value of $60,000. We apply 30% DV to that, which is $18,000. So our closing book value is now $42,000. Jump through to year 2, and you've got the opening book value is $42,000. 30% of that is $12,600. So that gives us now an accumulated depreciation of $30,600 and a closing book value of $29,400. Jump through to year 3, opening book value is $29,400, 30% depreciation, $8,820, closing book value of $20,580. So you can see how each year you've got a reducing expense for your depreciation, and that's just reflected based on the opening value of your asset. Under the straight line example, you can see that depreciation every year is the same amount. So you can just see how that works out. So same deal. Purchase cost was $60,000, 20% straight line. Depreciation is $12,000, and you can follow that through. And each year it's $12,000 expense in depreciation, and your closing book value diminishes by $12,000 each year. But it doesn't change, that opening position doesn't change the depreciation amount. So another part of the non-cash transactions in your P&L, the profit and loss statement, or your statement of financial performance, is your livestock. So the livestock trading account, which we're going to look at, which is page 14 and 15 in the statements that we're looking at. But the livestock trading account summarises all of our sales and purchases of livestock throughout the year, and it details the surplus or deficit of those two things, which is known as the cash trading surplus. and it also accounts for the opening and closing stock and any change in the values of this. So you can see the illustration is our cash trading surplus plus or minus the change in value of stock equals our stock taxable profit that we include in the P&L. So if we look at page 14 and 15, we can see that this shows us the total number of animals per stock class that are purchased or sold, and the average price per head for each stock class achieved during the year. It also details the opening and closing numbers and the values, and sales less purchases equals the cash surplus, which is reflected in the profit and loss. But closing values also match the balance sheet, so that's what's recorded as an asset. So just an example of how we work through this is the livestock reconciliation. So this is a process that we go through when we do your end of year accounts, okay? It demonstrates the process and the quantity of animals that we need to go through. So you can see the opening stock column, which is your 1675, where our total opening stock is 395. From the records that we've had and the transactions that have occurred through the year, we've come up with what we think were the births. You guys sometimes tell us, but not always. We've been able to record any purchases and sales that have happened throughout the year, also from the actual transactions that have come through your bank account. And then we do this aging transaction. So we say, well, the heifer calves that were born, they get aged into R1 heifers. R1 heifers become R2 heifers, R2 heifers become mixed age cows. And that gives us our closing position that's what we base our valuations on. Just to run through what each stock class means, because I know I have had numerous arguments with my partner and father about what is classified as an R2 in particular. So just thought I'd run through that. So this isn't necessarily accurate, but this is how the IRD does it. So this is how, as accountants, we have to do it. We really don't have a choice. So if you are buying or selling a calf, that is something that you're still feeding. So if it still needs milk or meal, it's a calf, okay? If it's weaned, it is an R1 animal, which means it's not yet 1 year old. Anything that's over 1 year old is an R2 animal. So 18-month steers, that's an R2. R3 is anything over 2 years old, and that's going to depend on what valuation method you're using as to whether R3s even have a value. And then MA, which is mixed age, that's anything for a cow, that's anything over 2. Hopefully, that's all clear as mud. It's really important here, and it's something that we see a lot of as accountants, is we really don't always get accurate numbers, and giving us accurate numbers and having a crack at doing this yourself can actually save quite a lot of time, which will then save you guys quite a lot of money.
Amanda, we just had another question from Kathy, which relates to a previous discussion around depreciation. And
yep.
She asks, so this year, for example, if you purchased a calf trailer for $4,500, would you be ahead with the depreciation rules versus buying it next season out of cash flow?
Yes, so if you bought that $4,500 trailer this year, you would be able to get that full deduction for that expense in this year. If you buy it next year, we would have to capitalise it, and then you'd only be getting a portion of that expense each year. So it kind of depends if you've got the funds available.
Okay.
If you're paying an overdraft, then that might be a bit more detailed conversation to have.
Perfect. Thank you.
Okay.
So just on that livestock one as well, Amanda, and what you sort of touch on there, that aging, and when we sort of classify things, the real importance there is whether you're valuing livestock under the National Standard Cost Scheme or the National Average Market Value Scheme, known as HERD scheme. Either way, that has a tax effect. And so if we're, I guess, aging an animal too early, then you are overstating its value in terms of its closing stock value for tax. So that's why it's quite important to get it accurate. It does actually have a flow-on effect into how that's stated in your books, not only on the balance sheet for what it's worth at a book value, but also as to how that affects your tax calculation.
And I just saw a question pop up, Jordan, about the date
Yes, yep. So just got one there. Thank you, Liam. So what is the date that they become 1 year old? Is it 30 June? So when you're sort of talking about that, we're talking about the aging as at balance date. So any that are, say, springborn of 219, they're going to be a rising one prior to the 31 May 2020 balance date. So all of them born in that year will come in as a rising one. Technically, they turn one, you know, in the spring of next year, but it means that come the May afterwards, they're then a rising two, you know, ready to carve down into the herd that next season. For autumns, it's a little bit different. You might actually be, you know, if you're autumn calving, you might actually be calving over your balance date. But again, if they're born in that first period, as Amanda said, if you're still feeding them, they're a calf. If they're still on hand at year end for tax purposes, they get counted as a rising one anyway. But it's more around if you're buying them in and feeding them, that's where we've got to be careful with that price for NSC. And again, with that aging, you know, that one that's still a calf or technically a rising one basically stays a rising one for autumn all the way through to next year. So they sort of, you know, it's slightly different for your autumn ones. And I think for those that have some specific questions around that, catch up with us and we can run you through. Spring, of course, is much more straightforward. It's just that first year they're born, they're a rising one until they turn one. And then the next year they're a rising two until they technically turn two. And that's at that point that they've actually carved down into the herd and they're part of the herd.
Awesome, thanks, Jordan. Okay, so I'm going to go through what Jordan was just talking about, herd value or NSC. So the herd value is actually officially known as the National Average Market Value, but we just coin it HV or herd value. So the herd value scheme comes with some restrictions. Once you are in, your base number must remain the same. And if you sell stock to an associated person, there are rules that need to be followed, usually meaning that they also have to use the herd scheme. So it just triggers a rule called associated persons rule. It's really important to discuss the plans with your advisors in case these implications cause issues. So I'll just reiterate there as well. We want to know your business. And the more we know about the business, the better advice we can give and the better, you know, the more we can help and make sure that everything that we're doing is actually going to enhance your future plans and help you to achieve those. So don't be scared to have those conversations. It can affect decisions that we make if we know what your plans are. Okay, so the herd value, as I said, is officially termed the National Average Market Value. It's meant to represent average sale prices New Zealand-wide as calculated by IRD. So they actually do employ stock agents and the like, and they review sales and purchase information throughout the year, and they can try and come up with this average value. It's announced around about the 20th of May each year. It's not out yet, I just checked this morning. And it increases or decreases, and any increases, or decreases in prior year stock on hand value, it's non-taxable. And I'll go into that a little bit more in a minute. The revaluation reserve contributes equity, or it can alter your equity position. Once you are in the herd scheme, you're in it for good unless you sell all of your stock. And it's treated like an asset. So you treat it, yes, it's an asset as opposed to trading stock. And it can provide a really good option for your capital stock. So that's as opposed to trading stock. So if you're a trading farmer, we may avoid this scheme. An example, I've run through the herd value example here. So I've kept the numbers small so that we can just get an idea of what's happened, and I've kept the numbers consistent. So you can just see that in a year when values announced decrease, you actually incur a non-deductible decrease in value of your asset. So this reduces your asset value, and it's also going to reduce your equity. However, in a year when the value is announced increase, you'll get a non-taxable gain on the value of your livestock, and that's going to increase your equity. If your closing stock numbers remain the same, there will be no tax consequence to that increase or decrease of livestock values. So hopefully you can follow that through. So in 2018, the R1 heifers were valued at 691, and we had 10 of them, so the total value is 6,910. So follow that through for all of those animals, and our closing position was 35,330. So that would have been recorded as an asset in our balance sheet. In 2019, the values actually decreased a little bit. And so you can see our total adjusted, and what we do here is we actually revalue the opening stock. We don't just change the closing value. We're actually reopening the revalue the opening stock. And so you can see there it says the adjusted opening value was 34,720, but the prior year closing value was 35,330. And you see a non-deductible decrease in value there of $610. Okay, so that will now go through the NSC version. So the NSC stands for National Standard Cost, and that the valuation of the NSC scheme reflects the costs of the purchase, breeding, rearing and growing of your animals. These calculations can get a little bit complicated, and there are different classifications for immature, mature, breeding, non-breeding that we can come across. That just makes it a little bit more complicated. The values for these under this scheme are generally a little bit lower than herd value, and that means that you'll incur less tax when we adopt what scheme we're going to use, but potentially you may incur a little bit more tax if you sell the animal. So I'll go into that a little bit more in a minute as well. So these values are announced usually in February each year, and as I said, they reflect the cost of breeding, rearing and growing the animals, and that's as announced by Inland Revenue. The calculations can get complicated, generally lower, and they split them into two categories. So you've got your immature and your mature livestock basically, and then it also splits off into breeding and non-breeding, which just adds an extra dimension of complexity for us. When we look at the example, we see the R1 heifer in 2018, we had it valued at $450, and again this was based on, it can be based on either as announced, or if we've purchased a whole lot of calves and reared them, then we actually include the purchase cost of the animal, and then we include a rearing and growing cost that's been announced by Inland Revenue. So that's how we come up with that value. And there's more complicated portions as we go through the other sections. But you can see in 2018, I had the values of 450, 12, 13, 13, 20, and that gives us a closing value of 30,000. In 2019, my closing values were a little bit more than that. And so I've actually got an increase in value here of $1,750 with the same base numbers. Now that $1,750 goes into your profit and loss and becomes part of your taxable income. Okay, so that's where the difference is between the herd value and the NSC values. So which scheme we adopt depends on individual circumstances. It depends on the cost of animals. It depends on the financial performance for the year, the stock type, whether you're breeding or trading, what your farm strategy is and what your future plans are. So that's again why it's really important to keep these conversations with your advisors open and active. Because if we know about your goals and aspirations, then understanding your direction can influence those decisions, as I said before. You can switch from NSC to herd. That's not an issue. If you're on NSC, you can opt into the herd scheme. And we often do this when herd prices are quite low, so when they get quite close to what our NSC value would have been. And the benefit there is that we just take advantage of the reduced price which can affect our tax implication. So that's livestock. So if you've got any questions on how that works, chuck them in chat, and we can try and answer them while it's still fresh. And then otherwise we'll move on to the milk production account. So the milk production account in our financial statements is on page 16. And this shows us the breakdown which details our monthly production, KGMS, and the proceeds that we've received each month. It shows us, we show 2 years of data. I think some accountants show more, but we show 2. And this total ties in with your profit and loss. So you can actually flick back and see on, I think it was page 11 and 12, the 460,161, the 2018 year, that will be showing as your total milk production and the profit and loss. So that's how they all tie in. So that's cool. There's not too much more to show you about the milk production statement. I forgot to mention also, actually, sorry, in the livestock values, you'll see that total, I'll just find the page, sorry guys. On page 14, you'll see the total, the net profit or loss from the dairy cattle trading, and that also pushes through to the profit and loss, if you want to go back and follow through how that all relates to each, because each page interacts with the others. So we'll jump through to the notes to the financial statements. And these are possibly some areas that you've never bothered looking at. And I have to say that I have been guilty of that in the past as well. But what they tell us is quite important sometimes. So the notes to the financial statements reports the accounting policies that have been adopted to prepare your financial statements. So that's important for us to meet our reporting criteria with the institute and things like that. An accounting principle policy, is the specific principle and procedure that have been adopted for your business. So they're not all the same. As well as these accounting policies, the notes also provide additional information that detail amounts that are summarised in the balance sheet. Okay, so it gives us, it sort of expands some of those prior things that we've looked at. Really useful for third parties, so banks and potential investors would often look at these in detail. Okay. So any questions on them as well, probably best to just come back to us individually with what might be in your specific accounts that could be you want a bit more detail on. Feel free to do that. The current accounts, these are shown on page 19. And this is your part of the account. So the current accounts show you how you have personally contributed to the equity of the business. So that's known as funds introduced. So for instance, if one of you works off farm and the money gets banked into the farm account, you would show that as funds introduced to the business. It also shows how much you take out of the business for personal use, which is what we refer to as drawings. The amount taken can be different to the amount of the profit of the business, which we went through in one of those earlier examples. And if you do that, you're going to reduce your equity or your wealth. If you draw out more than the combined amount of what you have invested plus what the business has earned, you will have an overdrawn current account if you're in a company structure, which effectively means that the business has loaned you money and you will need to pay interest on that loan. So that interest becomes income to the company and it's an expense to you. And the rates that that interest is charged is announced by Inland Revenue, and they're reasonably high. The tax reconciliation page is shown on page 20, if you're able to look. And this details the net taxable profit, which is calculated in the profit and loss. And then it details any add backs, which are the non-deductible amounts. Okay, and then summarises your business profit. So you can see here, there's an add back for an imputation credit there, which would have just been a part that wasn't taxable. When we show the tax payable on this taxable, when we show the tax payable on the taxable profit, we then deduct any tax already paid and show you the total tax that's due. And the amounts due and the due dates are then detailed in the actual tax return. Okay. So that's just basically the page that summarises all of everything that's happened, and then that's how what we base our tax calculation on.
So the big one in summary there, isn't it, Amanda, is I guess for accounting purposes, for the most part, for most sets of financial statements, especially for agriculture, they are prepared in line with tax rulings, but there are some things that are genuinely a cost to the business that just aren't deductible for tax, or things like you said, imputation credits that need to be grossed up. So really all that page is about is just reconciling the accounting profit, which is getting added to your retained earnings and becoming part of your balance sheet, versus the tax profit, which IRD are then actually assessing that income tax on.
Yeah. As an example of a expense that relates to your business that's not deductible, it could be a key person insurance policy, not an income protection policy, but a key person policy. That's an expense to the business, particularly if you're in a company, but it's not deductible. And the reason it's not deductible is that the income isn't returnable. So there's a nexus there, but it's a complicated piece of legislation, and we will help you review that if you had that situation. So the next thing I wanted to cover off is the income equalisation. It can be good. So the income equalisation scheme has been created to try and level out the ups and downs in the farming industry. with the idea being that in 1 year, when you had a perfect season and the payout's been really good and you have a substantial taxable surplus in the business, we can then, under the scheme, you'd be able to pay a portion of that profit to the inland revenue. You do have to physically pay it, so it doesn't sit well with everybody. And then revenue would then hold that deposit for you, and that amount usually needs to be held with inland revenue for a minimum of 12 months, after which time interest is paid and added to the deposit. The effect of that is that the amount of the deposit is deducted from your taxable profit from the year, thereby lowering your profit and tax obligations. So if you made $150,000 profit 1 year, you could physically pay $50,000 or however much was deemed appropriate. You could physically pay that amount to IRD, and then you would only, your taxable profit for that year would be $100,000, and that $50,000 would sit with the IRD until you chose to pull it out. In the following years, you might have significant losses, a drought, low payout, severe weather system, etc. And you can, at that point in time, choose to withdraw all or some of the deposit that you've got sitting within inland revenue. That money will then be put back into your account, physically put into your bank account with any interest that has been accrued. And that will then be added onto your taxable profit for that year, which then increases the tax obligation in that prior year. So we're literally just moving profit from 1 year to another. There's a few other rules, one of them being that the deposit can only remain within inland revenue for 5 years, and after that time it will be refunded regardless of whether you've had a good run or not, good profit that year or not. So if you have had a really good run and you just haven't had a bad year, you could actually get caught out having to return the deposit on top of an already significant profit. We manage this, we monitor this, and we plan to work around it. But the massive benefit here is, when you're using a cloud-based accounting system, is we can monitor those profits quite accurately during the year and make those decisions. And then revenue can also make amendments to rules when required. So, for instance, during severe droughts and things, they create different opportunities for this to happen. So they might let you pay a deposit and pull it out a week later if that cross-balance date to just transfer between years. So they're reasonably flexible if they need to be, and they also do let you withdraw the funds for hardship if you can improve. There's some sort of hardship there, but you just won't receive any interest on the funds that have been invested if it's held for less than 12 months.
So there are actually some rules in place currently around the 2020 drought, covering any farmers in North Island or northern parts of the South Island that have been affected by that drought. Which, just as Amanda said, there's discretion there. It's not a hard and fast. It needs to be negotiated around being able to pay that money in and then draw it out within quite a relatively short time frame, but have the effect of shifting that income between those 2 years. So something that we'll likely see being looked at and used if it sort of can be, but either between, there was the opportunity, we've already used it for some between 19 and 20, but possibly also between 20 and 21.
Okay, so then we jump into our CapEx, which is our asset ownership. So another time that it might be a really good idea to talk to your advisors is when you're looking to buy a big asset. So the definition of big is actually going to be dependent on where you're at with your business. So for someone who's in their first year contract milking, the decision could be whether to buy a new ute on a field day special with 3% interest on finance, or whether it would be better to just buy a $15,000 or $20,000 second-hand ute with cash that they've got in the bank. For others, it's going to be buying the runoff or buying a new tractor. If you're sorry, that's already gone through that part. So I've just gone through really high level. I haven't done the calculations with all the tools that I've got at hand, because this is just a real quick glance. So don't hold too much on the accuracy of it. So the new ute that you might have purchased in June, say you had a May balance date, so we'll get a full year's depreciation expense, which is what we went through on the depreciation examples earlier. You've got money in the bank. The cost price is $45,000, and the IRD announced depreciation is 30% DV. So we can only claim the depreciation expense for the month the asset is purchased onwards. So this one's bought in June, so we get the full 12 months depreciation. if you were to purchase it in May, you'd only get 1 month's depreciation. Hopefully that makes sense to everybody. If you sell an asset for more than the book value, the difference becomes taxable income if it's depreciation recovered.
So that point there that Amanda makes around, only claiming the depreciation from the time it's bought, probably one of the really common sort of questions we get asked and really common misconceptions is, if I buy an asset right before balance date, that's going to be better than buying it the month after, because I get the claim. But if it's an asset, if it's over those, like we said, the 5,000 or the 1,000, then it doesn't really apply. It's only small expenses that you're sort of then getting that claim, in this tax year versus next. If it's an asset that's going to be depreciated, then there's no real difference. Probably with the exception this year, of course, with that one-time extension or lifting of the limit up to 5,000 and then dropping back down to 1,000. But really, if you buy it in May versus back in, last June or in next June, it's just going to start deducting at a standard rate from when you've purchased it. There's not sort of a big claim that sort of happens clawing anything back.
So I've worked through the examples here. So in the first example, we've got the $45,000 purchase price, and we've claimed $37,437 in depreciation over the 5 years, which gives us a closing book value of $7,563. And then if you look at the ute for $20,000, you see the taxable income depreciation. Then we sell the ute. Sorry, I've missed the L's off my notes. If we sell the ute for $20,000, we would see depreciation recovered of $12,437. So that's the difference, $20,000 minus the closing book value of $7,563, and that's taxable because it's depreciation recovered. The total cost of owning that asset, therefore, is $25,000 or $5,000 per year. In the second example, we might sell the ute after 5 years for $10,000, giving the depreciation recovered of $6,639. So the total cost of owning that asset for 5 years is $10,000 or only $2,000 per year. So the things to think about, whether you could do something else with that capital, you won't get a return on your investment with a vehicle, unlikely to anyway. It's great to have a reliable vehicle, but could you have spent that additional money to repair and maintain the second-hand one and still have spent the same? So for instance, to spend the same as buying a new one there, you had $3,000 a year to spend on repairs and maintenance. That would have put you in the same position, but you wouldn't have outlaid all that money up front. So there's just things to think about there. And I'm not saying that there's a right or wrong answer, and I'm not saying that you don't deserve a good vehicle and everything else, but just things to think about. And it needs to be kind of based on where you're at in your journey through the farming career as well. So if we go to the purchase via HP, so this is just another option. So the asset purchase and reduction in value is the same whether you pay up front or you finance your purchase, okay? The asset is offset by the liability in the balance sheet because you've bought an asset, but you've borrowed to do so. So you've got an asset and liability there that equal the same amount with an HP. Under that scheme, your equity could actually be reducing faster than the debt is reducing because of depreciation. You've got an additional interest cost. So I've used 3%, which is very likely unrealistically low, but often you might get a really low interest rate on a new vehicle purchased. But the low interest rate is often baked into the cost price, so we sometimes pay more for it. We generally see HP interest rates ranging from between 6 to 16%, so it can be an expensive option. It can also be a good option. You would need to negotiate with the seller and see what the best cash price is versus the best deal both on price paid and principal financed and interest cost of an HP. We can assist you guys with modelling these options and advise the best options from a cash flow GST and tax benefit perspective. And HPs are also treated slightly differently for tax purposes. So if we jump to the next slide. So the total cost of the asset when you purchase it on HP is you own that asset, it is yours. We do capitalise it at that point in time. You also get to claim the full GST amount at the time that you enter that financial agreement. And quite often there'll be a balloon payment a couple of months later that gives the idea that you're going to use the refund that you get from the purchase to pay off a chunk of that debt. There's the additional tax deduction of the interest cost, but the monthly payments of the HP are not deductible. So that's just like a principal repayment of a loan. people get that wrong a lot. Okay, so that's something that you, even if you do go through this process, I think it's still really important to touch base with your accountant and say, hey, I've taken out an HP, how am I supposed to be treating this for GST purposes if you're doing your own GST? Another option that we see frequently is the asset lease. With lease payments, often the full amount of payment each month is generally tax deductible. There is no depreciation on these because you don't own the asset, so there's no reduction in value to your asset, okay? There's different types of leases, and these can affect the tax treatment. You've got to read the small print and get us to check it over if you're not sure. These payments can be almost the same as an HP, but you don't end up owning an asset. You also don't end up covering the reduction in value, and sometimes you don't have to cover the maintenance, again, depending on your contract. There's often a limit on the amount of Ks that you can do. So again, make sure you read and understand the contract because you can get penalised. I know I did an analysis with a client the other day, and we came up with a $6,000 benefit to actually putting it on HP over lease. So but they're not all the same. So it's all case by case, and just more things to think about, really. Another thing I just wanted to go over, and this is based on, I hear a lot, and I've got a lot of family that say this to me, that they want to have their own baler so that they're not waiting for the contractors to turn up. But it's just something that I've done a little bit of work on. So some more things to think about is, do you actually need all of that gear? What's the real cost of owning your own gear versus paying a contractor? Does it really pay for itself? And what is the cost to your business of actually having all that capital tied up in the equipment? So I talked to a contractor and got some actual costs so that we could try and make sure that we have the full picture in doing this, having this conversation. So before deciding on investing gear, really ask yourself, is it actually a good investment? So the example I've got here, cost to make 100 bales of silage versus via a contractor versus owning all the gear. Do these costs actually offset the cost of the contractor? Does the convenience of having all of the gear ready when you want it actually offset the additional cost of owning the gear? And how could the extra cash be utilised for your business? Are you an OD but have a shed full of gear? Like, that, to me, doesn't really make a whole lot of sense. Depreciation on the gear as well. So the depreciation, so in this example, I've got a mower conditioner, say, for $9,000, 8.5%. Depreciation cost for the year, $765. Same with the baler, tedder, and wrapper. It's come up with a depreciation cost for the year of $10,973.50. Consider the amount of bales that you could make based on the cost in the previous slide and the sale value of the assets. You know, there's some conversation to have here. So paying the contractor based on the prices in the previous slide, I could make 200 bales for $8,600, but I've spent $10,000 in depreciation. So again, just conversations that need to be had before you decide to invest in all of that gear.
Amanda, just a quick time check. We're at 12, so we've got another 15 minutes to go.
Yep, no, that's cool. I'm perfectly on target.
Perfect.
So you've still got to repair. You've still got to think about some other things. So repairs on that gear. Quite often, as a farm owner, we'll buy sort of secondhand gear, and that's breaks down. Let's face it. So you've got the maintenance. You know, even just general maintenance. Blades need replacing. Gear needs to be serviced, etc. Your cost of finance. Are you going to be buying this gear via an HP or using bank overdraft, or have you actually got the money in the bank? Considering the effect on your equity as the asset depreciates. So just having it sitting in the shed, if you're not using it, that's actually diminishing your equity. That's reducing in value. What is the effect on the cash flow under all of these different scenarios? Is your bank overdrawn but you've got a shed full of equipment? And how much of your own time or your staff's time are you actually having to invest in using the gear? So that pretty much covers off what I wanted to today. Our next session is on budgeting, making it measurable. And my key tagline there is, running a business with no budget is like taking a shot at goal with a blindfold on. So what gets measured gets managed. We want to take control of your outcomes and control the controllable. So that's what we'll be covering off next time. So any questions now, feel free to fire them at us.
Amanda, just before we get anyone drop off, I just want to say, for the next session, you will have to register separately, so don't use the same link. Come in separately. on a separate link. And if you need that, just get in touch with me and I can flick that out to you. But now's probably a cool chance that if you want to, you can just take yourself off mute and ask Amanda and or Jordan any questions that you've got.
Awesome, thanks, Mark.
So, Mark, just to confirm as well, the time and date for the next session.
Thank you. So that's at 11 o'clock on Thursday. So Thursday's the 21st, and so exactly the same time.
Brilliant. And you look, encourage you to ask any questions, whether it's via the chat or taking yourself on mute and asking now, guys. Not often you get a have a crack at a couple of accountants, and we're not on the clock, so make the most of it.
There's one there, Jordan, about Cash Manager. Would you like to answer that?
Yep, we're currently using Cash Manager. What are your thoughts on this? So, Carl, just to check, do you know if that's Accomplished Cash Manager or Cash Manager Rural? I'll assume it's rural, but there is sort of two floating around there. So Cash Manager Rural, awesome locally grown product out of Martin there, but they probably didn't quite keep with the times when it came to investing in the cloud. They had an opportunity to be part of the Xero platform, but they lost out on that to Figured. They wanted to be a full system. What we then saw is they've invested a lot of money and a lot of time over the last probably 2.5 years to develop what they're calling their Cash Manager Focus product, and that is a fully online cloud-based product. And that is good from what we've seen. It's still early days. It still has a few, sort of niggles and bugs like a new product will, versus something like Xero and Figured, which is a bit more of a mature product now that has been well used. Probably where we're seeing it, not yet catch up is it has some integrations, but where sort of Figured's ahead of the game as it has wider integration. So the ability to do things like benchmark and do long-term scenario planning in a really effective way is where they've sort of caught the market. So definitely not a bad product by any means, does a great job, very easy to use. But you'll probably find that, I guess, it's going to be an interesting one just as to where that sits price point wise and how they can continue to fund development, being still a relatively small company and having lost a lot of users to Xero and Figured in the last couple of years. I think potentially I'd be surprised if they're around in another 5 years. But great product in the meantime, and they've done a really good job of sort of building it to where they have.
Hopefully that answers that question, Carl.
So then we've just got another one here. If we can't make the next meeting, we'll be able to watch a recording later. If you, from my understanding, if you still just register for that webinar, even if you can't make it, then you'll be on the email list to get a copy of the recording sent to you. So just make sure you register, and then we'll reply to all of those who registered, even if you couldn't attend, and send you a copy. Just had somebody else ask you about Accomplished Cash Manager. I'd say I've probably got a far dimmer view of Accomplished Cash Manager. So they really failed to innovate for probably the last sort of good 6 years. Accomplished was a great sort of cash book only product out on desktop, could do a little bit of invoicing and the like. Was really in its heyday when I first sort of started with Baker Tilly 13 odd years ago, and was sort of competing with the likes of Banklink then. It's good if you have just absolutely no internet connection and you need a fully desktop based system. But again, probably the big thing that they failed to do is move to a subscription service, and therefore they didn't have a regular stream of revenue, and so they've just not had the funds coming in to be able to pay developers to stay ahead. We definitely wouldn't be putting any clients onto Accomplished Cash Manager, and most of them tend to be moving off to a cloud-based system that has all those benefits of live bank feeds and automated backup and the like.
You tell us what you really think, Jordan.
Yeah. I think the big thing with those products is that the collaboration piece isn't as flexible as it is with the cloud-based systems. So when you're on a cloud-based system, we can work with you a lot easier. We've got access to real-time information. We can help with, updating forecasting and getting a really good, accurate closing position. And being online makes that collaboration a lot easier.
Yep, dead right. This is, I think, almost one for you there, Mark, thinking across the dairy and Z sort of stats. What farm working expense per kg of milk solids would you be targeting for next season?
Gonna cover my ass and say as low as possible. No. Look, I guess it's all relative to two things. It's relative to the amount of debt you have to pay. So all I would be doing now is doing what's your break-even milk price, because then you can start changing things. And I think Phil's online from Dairy Base who might add in a little bit here, but what's milk price going to be? Don't know. I would probably be doing two sort of break-even milk prices. One, what happens if it is low, like Rabobank are talking at 5.50? And then say, what's your break even? What are my debt repayment requirements, interest requirements, drawings? And then, okay, well, what can my farm working expenses afford to be? And then maybe do another one for most banks are picking, Jordan, what, mid sixes, low sixes? So maybe do another one at 620 and say, what does it do there? And I say drawings in there. Drawings are important. You start skimping on that, other things go downhill quickly. So you do need to be realistic about them, of course, but that's how I would figure out my my farm working, because if your debt's at $10 a kilo, you can have much higher farm working expenses and depreciation than someone whose debt is at $40 a kilo. So.
Yep, no, I think that's a really good way of looking at it, Mark. The other thing I'll probably encourage there, and that goes back to, you know, the discussions you have with the likes of your nutritionists and your farm consultants is, you know, if you look at your inputs, what is the marginal profit on that additional spending, especially when it comes to imported feed, you know, and that's where in a high payout year, you know, that can actually look quite good. Probably the big thing we're facing this coming season is we're still got quite high imported feed costs. And looking at it, you know, potentially somewhere between a 550 and a 650 payout, so maybe a $6 mid-range, that marginal profit on feed starts to not look so great. And that's something you want to be really, really aware of. And part of what Amanda covers off in next session is really, really pertinent there around, you know, being able to manage and measure things, but also how you build that plan and what considerations go into it as well. So having an understanding of what your break-even milk price is on the status quo of what you're doing right now is really important. But then thinking about, you know, what is that that conversion that you're getting on that imported feed versus, you know, and how much that's going into just, you know, sort of your maintenance versus additional milk, and what that's actually costing you versus what you're receiving. And then cash flow wise as well, you know, if we're thinking about, say, a $6 payout, if you're a Fonterra supplier, they've announced their new sort of guidance that they're looking to have an opening advance of about 65%. So if it's a $6 mid-range, it'd be $3.90. And that might go through to somewhere, you know, at a $6 payout between, say, a $4.60 to a $4.75 sort of May, pay, June. So you're not receiving all of those funds up front, but you are incurring that feed cost up front. So you've got to be able to manage that, you know, that working capital or overdraft requirement through that time as well. And one of the good places as well, if you're wanting to look at that farm working expenses per kg milk solids, really, really good resource is, of course, Dairy Base. If you don't have your farm on there, you know, highly recommend that you look to do so. And you can start to then compare your farm to others of a similar, you know, sort of system type and location.
Yeah, I was going to say, one of the cool things about Dairy Base is that the number of Taranaki farms mean that we can get some really local comparisons. So you don't necessarily have to have a comparison against, say, the whole of the North Island. If you're a 50-50, we can pull something a little bit closer to home about what our local, what you can compare to locally, which is quite a cool resource.
Yep, just on that too. So something that we have worked on with at Baker Tilly is we've worked directly with Dairy Base around a direct upload. So rather than you having to send your financials off or having to manually load information in, you sort out the farm questionnaire type of thing. And then as soon as your financials are finished, we can just have an automated job just sitting there ready to automatically upload that into Dairy Base. So if you let us know you're on Dairy Base and it's something you'd like us to do for you, then we can just schedule that as part of your annual compliance work.
Okay, so here's another question. I'm not sure, Amanda or Jordan, you guys can decide. Are you, from Jackie, are you better to work in overdraft as in you pay less tax, or better to never hit overdraft?
Yeah, so it's...
Yeah, so sorry, we're both jumping on that one.
Yeah, that, Amanda.
Basically, if you're going to pay $1 in interest to save 30 cents in tax.
Yeah, that's it. So probably the balancing of an overdraft there is, you know, your overdraft is going to be at a higher interest rate than your term debt. but you'd ideally only want to use it for part of the season, and that's where it makes the most sense. Sort of, if you think about a typical spring farm, you know, you're going to be riding into that overdraft over that winter period, and hopefully sort of coming out of it around spring. That's that sort of curve you want to see, that if you can get back out of overdraft, you know, and be, you know, sort of come to a break even or close to zero position at the end of the season, or a bit in funds, you know, that's probably the ideal mix of where you're sitting. If you're finding you're in overdraft the whole time throughout the year by a significant amount, then there's probably actually a portion of that that actually really is just term debt, and you might be better actually discussing with the bank about getting that on a term debt parcel at a lower interest rate. And if you've got a facility sitting there that you never ever use, you know, that's not necessarily a bad thing either, but you probably want to look at what that facility is costing you just to have open and have available. Usually there's some sort of line fee or monthly account fee there just for having it available, even if you're not using it.
Yeah, I think really important comment to make there as well. At the moment, the current banking climate's got something to mention there. So they are really paying a lot of store to your account etiquette. So if you're actually living in overdraft, I don't know that that's going to be looked upon favourably in a couple of years' time when you want to actually expand and take some term debt and things. So just some things to think about there. But yeah, generally speaking, we try and encourage clients to stay out of overdraft. It's great to be able to forecast that and see when we're going to need the facility, because most people do need it, you know. Being realistic, we do need it for a period of the year, but if we are significantly overdrawn for the entire year, then like Jordan said, potentially some restructuring of loans there could be beneficial.
Yeah, and just to speak to the flip side of that, if you're always in funds and have an overdraft facility, I'll be surprised if the bank hasn't already shoulder tapped you, but they'll probably be looking to actually use some of those additional funds to make a lump sum debt repayment, and that does make sense as well, because then you are permanently saving that interest cost on that debt, provided you're not needing that money, or if you are needing the money for a future project, you know, looking to structure that in a way where it's in a facility that you can redraw, you know, such as a revolving credit facility.
Yeah, that's awesome. So Jackie just said generally try to never use it, but have a 20k limit, which is probably matches perfectly with what you're talking about. Hey,
and with a low limit like that, that's not too much to worry about. It's more if you know, if you had one sitting there for 100,000 or 200,000 that you weren't using, then you'd probably want to have a bit of a rethink.
Yeah. Hey, just looking at the time, we're bang on 12:15. So is there? No, thank you for coming on, Jackie. She just added her thanks. If there's one more question, I think we can probably squeeze that in. Otherwise,
and or just feel free to flick Jordan or an email as well. We're more than happy to answer any queries that you might have that you didn't want to ask in this situation.
Yeah, okay. I think just want to say a massive thank you to all of you for, you know, taking the time to join with us today. And big thank you to Mark and the team at Dira NZ for partnering with us on this as well. So looking forward to the next session.
Yeah, hey, look, I'll just say this generally, thank you guys for your time and effort. I know it's a huge time to put all that together, and then we've got 2 more, so I really encourage you guys to jump on the next 2 as well. And Teresa just did a great comparison between owning gear and or using contractors, which is always an interesting discussion on farm, that's for sure. So thank you guys very much for your time, and hopefully we see as many as possible on